Greetings. We are back with April's commentary video, and it's neither good nor bad. It's neither bull nor bear. This has been a choppy month, an unbalanced month. A lot of factors are coming at us. First quarter earnings, sentiment numbers, Fed decision, the Fed quiet period, and all sorts of economic data that's rolling in softer than expected. There's some cracks, people, but it's not all bad. The market has been pretty resilient so far this year. I'm recording this on Wednesday, April 26th. Most of you will see this in a couple days, so let us get into it. I'm going to share my screen. So those of you that have been following our writings and video commentary know that we very much keep track of sentiment, meaning how investors are feeling about the market. And this is the conference board survey, which essentially looks at how many folks are optimistic, bulls, how many folks are pessimistic, bears. And they create a spread where if it's a positive spread, meaning there's more bulls than bears, that means people are optimistic. If it's a negative spread, meaning more bears than bulls, it's a negative spread, okay? And the feelings are attitude towards equities. So again, a bullish attitude towards equities mean you think markets are going to go up. Bearish means you think the markets are going to go down. We are in the 16th consecutive month of bears outvoting bulls, meaning more people are feeling bad about markets than are feeling good about markets for 16 consecutive months. So this goes back to 1987. And just for some context, back in the spring of 2009, during the financial crisis, this metric hit 18 consecutive months. Well, guess what? The spring of 2009 marked the bottom. And from this point forward, future returns were overwhelmingly positive. Okay, so this is getting into financial crisis territory with the attitude of investors. And historically, when people feel the worst, future returns are usually better. And that's how markets work too. When stock prices go down, inherently that could mean future returns are higher. When stock prices go up, inherently that could mean future returns are lower. So starting point sentiment very much matters for future returns. Unfortunately, many people do the opposite. So covering past blogs from tracking retail investors and professional investors' favorite asset class, it's overwhelmingly cash. And this graphic shows that. So this captures money market and bond fund flows from December 1st of 22 to the end of February 23. So 3 months worth of data. Money is pouring into money market funds, some bond funds, but those are more mixed. The overarching conclusion is people love cash right now. We're getting more inquiries about how I can optimize my cash. Folks that would normally put money in their long-term core investment portfolio are parking it in cash, which that's not the worst thing. This is the first time in 10 plus years that you've been able to generate a reasonable return on safe cash. But in my opinion, this has gone a bit overboard. And I think it's charged with emotion, with fear on what happens next. And as you can see too, during this period, during this 3-month window, equities have actually gone up. So as I've said before, the reasons for recessions, the reasons for market sell-offs change. Investor behavior does not change. People become more fearful when markets go down. They become more greedy when markets go up. And looking at the data from sentiment to fund flows, it really should be the opposite. So this is the S&P 500 from 2005 to 2023. And the red areas, so back to my sentiment graph to start, the red areas represent when there's more bears than bulls. So the red areas represent people feeling bad about the future prospects for equities. And there's some interesting takeaways here. So the dark patches, if you can see that, there's a dark shaded gray highlighted on some of these red lines, okay? So the dark shaded area represents when that bull-bear spread is negative for 9 consecutive months or more, which I think is important, because when sentiment is negative for 9 months or more consecutively, you can see that's often a precursor to markets going up. So let's just look at these dark gray boxes. Right here, sentiment was negative for 16 straight months. Almost immediately, markets sprang higher. Same thing in 12, same thing in 13, and the same thing is happening now. What's unknown is the timing of some of this, right? This gray box could be gray and you could see a flat line or even markets going down. So again, this says nothing about timing, but it does show over a 18-year period, almost 20-year period, that consecutive months of negative sentiment can be bullish for future stock returns. And this zooms in on the financial crisis. So November '07 was roughly the peak, and this is the S&P again, to February 2010. So the bottom was right here, and this marked the 16th month of negative bull bear spread, for the sentiment survey. So for all of these months, going back 16 months, people were feeling horrible about future market returns. And from that record consecutive month spread, we all know what happened after this. Markets raced higher and didn't look back. Again, I have to be careful for compliance purposes. This is not a promise of future performance, but history rhymes. And I've never seen a more pessimistic market environment, both with the folks I talk to and the sentiment surveys. And I get a lot of folks saying, well, let's just wait this out and maybe get more aggressive in the summer. And again, that's not how markets work. So markets are going to sniff this out when it feels the worst. That's often when you should get either reinvested, or if you're thinking of getting more aggressive, that's often a decent time to do it. Okay, moving on. So we're getting a lot of recession talk, and now I think it's starting to be justified. So a lot of the economic data, which I'll show you in future slides, is starting to come in a little softer. So I get people telling me all the time, Nick, I'm worried about a recession. When can we expect one? And I've said this before. I mean, the whole recession narrative is kind of futile. People can't even agree on what a recession is. A recession, to me, is essentially a change in investors and consumers' behavior. It's a change in their risk appetite. So I'm a big fan of focusing on what we can control. We can't control when the government calls a recession. We can't control when the economic data turns down. What we can control is how we're invested, okay? So what we've done here is we're highlighting average recession performance since 1972 for several major asset classes. Okay, so that's in this left graph here. And average recession performance since 1972 for long bonds, intermediate term bonds, and short term bonds are the leaders in the clubhouse. Okay, and when you think about a recession, the Fed usually is cutting rates, which bond yields and bond prices, when the Fed is cutting rates down, usually go up. What's unusual about this cycle is the Fed continues to raise rates, recession warning lights are flashing, and it's creating a confusing environment for a lot of people. But zooming out and looking at the last almost 52 years, 51 years, we can see bonds usually act as a buffer to the riskiest asset, which is equities, right? So you see equities down in every recession since 1972, longer term bonds, intermediate term bonds. And keep in mind, these are all quality investment grade, either sovereign government bonds like US Treasuries, maybe high quality corporates. You can see lower quality bonds in the form of high yield bonds are basically flat. And then if you want to drill down more into the data, and you can pause this if you want to look at this, we itemize each individual recession by period. So you can see how these various asset classes, which are the same as over here, have performed in each one of these economic downturns. And what's interesting about this, you can see the stocks are all over the place. And this might confuse people or shock people, but stocks sometimes go up in a recession where expectations are for an Armageddon scenario, things are less bad and stock prices go up. Back in '08, people were thinking maybe there was going to be a mild recession. It turned out to be much worse, so stocks went down a lot more. So it's all about expectations. But overwhelmingly across the board, you can see bonds are really the place to be if you are a doomsdayer and you think things are going to get worse. Okay, So now let's look at some of the equity market components in which we track. And this changed pretty dramatically. And during my last video, I believe it was March, we talked about how the internal sector performance and semiconductor performance was not validating a lot of the pessimism out there. That's changed in about 3 weeks. And if you remember my comments last video, semiconductors are thought of as the transports of the 21st century. So there's a saying, as go semiconductors, as go the market. And the reason is semiconductors, so these chips, go into many of the consumer electronics in which we use every single day. From your cell phone, to your smart TV, to your car, semiconductors are a major component. And what has happened over the last month, so if this is March here, and the blue line is a semiconductor index, and the blue line represents relative strength versus the S&P 500. So when the blue line is going up, that means semiconductors performance is strong relative to the S&P. When this blue line is going down, that means semiconductor stock performance relative to the S&P is weaker. And there is a definite relationship between the blue line leading higher and the S&P, which is this light gray line, following. All right. Relative strength for the semiconductor index has gone down over the last month, and the S&P 500 has not really caught up to that, right? So you see this line going down over the last month. You see the S&P is still kind of lagging. It's probably somewhere down here because we had a nasty sell-off on the 25th of April. So if this holds, it wouldn't surprise me if the S&P dipped below this 4,000 or 4,100 mark, which it already is under this 4,100 mark. Okay, so this is something that we watch very closely. Leading indicators. Okay, so this chart perhaps is the most alarming to me. It's batting 1,000 in predicting recessions. This goes back to 1959, and basically what this is doing is it's tracking a basket of economic data points and tracking the year-over-year change. Okay, so year over year, you can see economic data, which it tracks employment, GDP, all sorts of stuff. There's like 15 metrics. And when this line is going down, going back to 1959, that usually corresponds with a recession. Okay, so these light gray bars represent a recession. Okay, so I don't know if you can, they're not showing up that dark, but hopefully you can see them. But there's a clear pattern. Line goes down, recession. Line goes down, recession. Line goes down, recession. So again, this is batting 1,000. And you can see recently during the financial crisis, line goes way down. We had a pretty deep and long recession. 2020, there is a recession there, violent detraction in the economic data. This was during COVID, but things bounced back rather quickly as the government stepped in. Now we're getting this violent downturn. Haven't yet declared a recession, but certainly it wouldn't surprise me if the government calls it one shortly. And all a recession, and again, the government has changed the way they define it. Usually it's consecutive quarters of negative GDP growth, but if it looks like a recession, it smells like a recession, it could be a recession. And it's not uncommon for the government to look back and say, okay, the recession started in summer of 2022 and it ended in spring of 2023. So it's not uncommon for them to go back and retrofit a recession based on things becoming more clear as time passes. So if there was one metric in which we're tracking that, as a hat tip to the bears and for the people that think things are going to get worse, this could be it. All right. So one of the last economic data points not to break down, to be very resilient, has been the labor market. But that's starting to show some cracks. And if you don't want to drill down to the data, just look at the daily news. It seems like every single day we're getting multiple companies saying they're laying off X amount of workers. All right. So what this is the number of Americans receiving unemployment benefits by income level. All right. So you have low wage earners here, high wage earners here. The dark blue graph, dark blue column, shows those receiving unemployment benefits last year during the same period. The light blue is Americans receiving unemployment benefits during the current period over the last 7 days. So same period, dark blue a year ago, light blue currently. And there are a few exceptions, but overwhelmingly, these light blue current bars are higher, meaning more Americans are receiving unemployment benefits. And it's almost uniform across income levels. And it's perhaps most dramatic at the highest income levels. Okay, so this is another look at the job market where this goes back to the start of last year. The light gray line is initial jobless claims, and here's the left axis, so the light gray line. So as the light gray line goes down, that means fewer people are filing jobless claims. As this gray line goes up, it means more people are filing jobless claims. What's interesting about this is back here when the Fed was raising rates and people were getting jobs and getting off jobless claims, it was almost a good news is bad news thing, right? And what I mean by that is usually people getting jobs and earning money to support their family for the economy and going out and buying stuff would be a good thing. But the Fed was worried about inflation. They were worried about wage growth, maximum employment. And so when people were going back to work, the market, this dark blue line, was actually going down. Okay. So again, good news, people getting jobs was perceived as bad news to the market because it meant the Fed was going to keep hiking. Now jobless claims are going up and the market is starting to track up. So this is quite confusing, but it's almost like if more people lose their jobs, the Fed can pause. Eventually, the Fed, if enough people lose their jobs, the Fed is going to cut, which in theory might be good for stocks, and stocks could go up. So it kind of points to the absurdity of the Fed at times, where they're increasing rates so people lose their jobs. They'll pause, they'll cut rates so people can get back to work, and markets will go up. So the Fed catches a lot of flack. That's part of the reason why the absurdity of some of their monetary policy decisions. But looking at the futures, it looks like May, which the Fed is going to meet next Wednesday, I believe, if I have my dates straight. It looks like they're going to meet in May. The market expects the Fed to hike by 0.25%, and then it looks like we are going to get a pause in June and potentially a cut in July. So we're in the bottom of the ninth, it looks like, with the Fed's hiking cycle. But this is sort of confounding action, and again, why the Fed gets flack in some respects. So that's it for April. I tried to play both sides. There's some good, there's some bad. I talked to a lot of people, a lot of smart people, and for every smart person I talk to, one is optimistic. Another is in the camp that things get worse. I was looking at stock prices over the last year, and it's been extremely choppy. In this environment, many people are going to experience pain. You just want to keep it on the rails. I don't think it's the time to reach for return or reach for yield or take a bunch of risk. Again, when you take rates being at zero and you increase them at the fastest pace in 40 years, there's going to be boogeymen or women or people hiding under the bed. So it's really tough to predict what is going to derail us next or what's going to be a catalyst for things to get better. In my opinion, it's good to be open-minded. It's good to be flexible. Try to stay away from the extremes, either bullish or bearish, and know that things change quickly in this environment. This is unlike any cycle that I've seen. There's no playbook for coming out of a recession, for coming out of a pandemic. And a lot of the market action really contradicts each other. For every positive metric, there's a negative metric. So again, I think being open-minded and having the ability to change your mind is a powerful asset. So if you have any questions, if you have any feedback for us at Pure Portfolios, shoot us a note at insight@pureportfolios.com. We also recently launched a new website, so check that out. Love your feedback on that. If there's a few bugs, that's to be expected. Thanks for watching. Thanks for listening. We'll see you next time.